The fundamental investment thesis for ING Groep N.V is predicated on its status as a highly capitalized, operationally efficient European global systemically important bank (GSIB) that successfully translates structural advantages, primarily a dominant low-cost European deposit base and advanced digital architecture, into superior earnings power and consistent shareholder returns. The bank's commitment to disciplined commercial growth and income diversification is evidenced by its strong 2024 financial performance. In the fiscal year 2024, ING reported a full-year net profit of €6,392 million, underpinning an outstanding return on equity of 13.0%. This level of profitability is critical for self-sustaining growth and capital generation. Concurrently, the balance sheet exhibits exceptional resilience, concluding 2024 with a Common Equity Tier 1 (CET) ratio of 13.6% and a stable leverage ratio of 4.7%. These metrics position ING securely above prevailing regulatory minimums and internal targets. The bank's strategic focus on capital efficiency supports an attractive shareholder distribution policy, which targets a 50% payout of resilient net profit through cash dividends and share repurchases. This comprehensive approach delivered a total shareholder yield exceeding 15% in 2024. A key observation of the current market positioning is the apparent disconnect between ING's robust financial quality and its valuation multiples. While the current price-to-tangible book value (P to TBV) of 1.34x and a price-to-earnings (PE) in the range of 10.76x to 13x reflect a recognition of present earnings, they remain modest relative to a 13.0% ROE and its capital strength. This implies investor skepticism regarding the sustainability of high earnings, driven by concerns over future net interest margin (NIM) in a potential lower interest rate environment. This market pessimism creates an intrinsic value gap estimated by some valuation models to be substantial. However, the bank's successful diversification into non-interest income streams provides a mitigating factor against interest rate volatility, suggesting potential for a significant re-rating as the sustained quality of earnings becomes evident to the broader market. ING is thus viewed as a quality investment currently trading at a moderate premium to its historical averages, offering both defensive capital characteristics and upside potential driven by structural efficiency. Corporate profile and strategic context. ING Groep N.V operates globally, though its strategic and financial strength is centered around a strong European base where it provides both retail and wholesale banking services across over 100 countries. Business model and geographic focus. The current corporate strategy, branded as Growing the Difference, is executed through two primary priorities: delivering superior customer value and integrating sustainability into core business decisions. The bank aims to be recognized as the best European bank, most loved, most valued, and most impactful across its markets. The retail banking division is transitioning toward a more tailored approach, moving away from mass market services. This customer-centric strategy has translated into significant commercial success, demonstrated by an increase of 1.1 million mobile primary customers in 2024, bringing the total base to 14.4 million. This growth was strongest in core markets, including the Netherlands, Germany, Spain, and Poland. Within its core markets, specifically the Netherlands, Belgium, and Luxembourg, ING benefits from a dominant local position. Notably, in the Netherlands, ING commands a 40% share of current account deposits, making it the largest retail bank by market share and total assets. This substantial market share provides a crucial low-cost, resilient funding advantage, which is a major structural support for future net interest margin stability. The wholesale banking division is strategically focused on deepening its relationships with clients, aiming to evolve into their strategic partner and core bank. This typically involves specialized lending, tailored corporate finance, debt and equity solutions, and increasingly sustainable finance solutions. Strategic enablers and operational efficiency. Operational efficacy is supported by four enabling priorities, with technology and sustainability being paramount. ING emphasizes the use of scalable technology and modular operations to foster a superior customer experience, enhance safety, and drive cost efficiencies. The inherently low net capital expenditure profile, discussed later, is a direct outcome of this digitally focused operational strategy. Sustainability is a cornerstone of the bank's ethos. ING has set goals to achieve net zero operations and actively supports the low-carbon transition by steering financing towards global climate objectives, collaborating with clients on their own transition goals. This dedication is validated by strong external validation, including an AA ESG rating reconfirmation from MSCI in August 2024 and a low-risk ESG risk rating 17.2 from Sustainalytics. C. Competitive and regulatory environment. ING operates in a highly competitive European and global banking landscape, competing directly with large institutions such as BNP Paribas, BBVA, Deutsche Bank AG, and Coöperative Bank UA. Its classification as a GSIB mandates strict adherence to the complex European regulatory framework, including the rules derived from the Basel III framework and transposed into the Capital Requirement Regulation and Directive, CRD4. The resilience required by these regulations is tested by external macro factors. The European Banking Authority has highlighted ongoing geopolitical volatility, a fragmented economic outlook, and rising operational risks, particularly cyber threats and fraudulent activities. The bank's exceptionally strong capital base is essential for mitigating credit risk exposure to sectors impacted by tariffs or supply chain disruptions stemming from these geopolitical events. I. Financial performance analysis, income statement review. ING's income statement for fiscal year 2024 demonstrates robust financial health, underpinned by high operational efficiency and successful income diversification. A. Revenue generation and total income components. Total income for FY 2024 reached €22.6 billion, reflecting sustained commercial momentum. This resilient performance was achieved through a favorable mix of net interest income, NII, and non-interest income. Net interest income dynamics. Net interest stability was maintained through strategic balance sheet management focusing on core commercial growth. The bank reported net core deposits growth of 7%, €47 billion, significantly outpacing the net core lending growth of 4%, €28 billion. This dynamic of deposits growing faster than loans stabilizes the funding structure. A larger, lower-cost liability base inherently reduces the overall cost of funds, enhancing the net interest margin structure and insulating NII to a degree from potential cyclical pressures. Non-interest income diversification. A critical success factor in the 2024 income statement was the strategic expansion of non-interest income. The bank achieved double-digit growth in fee income, which surpassed €4 billion for the first time. This milestone is structurally significant as it fundamentally improves the quality and long-term resilience of ING's earnings profile. Banking profits, particularly NII, are highly sensitive to the interest rate cycle. As central banks potentially move towards rate normalization, NII may face compression. The expansion of the non-interest revenue base, however, introduces a revenue stream that is substantially less rate sensitive. By increasing the contribution of recurring service fees and cross-selling revenues, which are less volatile than trading income or pure NII, ING successfully mitigates some of the cyclical risk in traditional lending. This diversification supports a higher long-term earnings multiple and reinforces the ability of the bank to maintain its high return on equity, ROE, even through periods of macro uncertainty. B. Cost management and profitability metrics. While detailed efficiency ratio data is not provided, the bank's strategy relies on scalable technology to drive positive operating leverage, where revenue growth exceeds cost growth. Continuous investment in technology, although generating low capitalized CapEx, requires operational expenditure, OPEX, to combat rising operational risks, especially cyber threats, which are increasingly prominent across the EU banking sector. The strong revenue engine translated into a full-year profit before tax of €9,300 million, culminating in a net profit of €6,392 million. This financial outperformance resulted in a full-year ROE of 13.0%. This high level of profitability confirms that ING operates well above its presumed cost of equity and generates substantial internal resources necessary for capital accretion and supporting shareholder returns. V. Balance sheet strength and asset quality review. The balance sheet of ING is characterized by prudent management of assets and liabilities, focusing on controlled commercial expansion while maintaining high asset quality in a challenging economic environment. A. Asset and liability structure. The commercial growth strategy is evident in the expansion of both sides of the balance sheet. Net core lending increased by 4%, 28 billion euros across all markets. More notably, the growth in net core deposits at 7%, 47 billion euros, enhances the stability of the liability base. The quicker pace of deposit accretion reduces reliance on potentially more volatile wholesale funding sources, which is a structural advantage, especially given ING's dominant deposit franchise in core European markets. B. Credit quality and non-performing exposures, NPEs. Overall, asset quality remains resilient, with risk costs consistently tracking below the bank's through-the-cycle average. This reflects generally strong underwriting standards and a favorable loan portfolio composition. Despite overall resilience, an analysis of non-performing exposures, NPEs, indicates emerging pressures in localized segments. The final stock of non-performing loans and advances increased to 13.045 billion euros at the end of 2024, up from 11.352 billion euros in the previous reporting period. This increase was primarily localized, with the defaulted exposure being most significant in Other Europe and Poland. While this increase is contained and the overall non-performing loan ratio, NPL, remains below the critical 5% threshold required for standard institutions, the geographic concentration of new defaults serves as a crucial leading indicator of localized macro stress. Consequently, management must maintain vigilant provisioning and monitoring of these segments. C. Risk-weighted assets, RWA, and capital deployment. Total risk-weighted assets, RWA, reached 333.7 billion euros as of 31 December 2024, increasing from 328.5 billion in the previous quarter. The composition of this increase is crucial for assessing capital efficiency. The primary driver of the RWA increase was higher credit RWA, rising to 282.1 billion euros. Excluding foreign exchange impacts, the increase of 2.4 billion euros was mainly attributed to business growth, plus 3.4 billion euros. This composition indicates a high-quality expansion, as the RWA growth is productive, stemming from commercial strategy, rather than being driven by model changes or deterioration in the risk weighting of existing assets. This affirms that the bank is achieving high-quality balance sheet growth, successfully expanding its commercial footprint while keeping credit risks manageable. This productive asset growth, combined with stable or below-average risk costs, allows the bank to meet its lending and deposit volume targets. However, the observed increase in the NPL stock, even if contained, necessitates the maintenance of the robust capital buffers. The strong CET1 ratio, discussed in the subsequent section, functions as a preemptive defense mechanism against the inevitable normalization of the credit cycle and any increased provisioning requirements that might arise from localized pressures. V. Capital adequacy and regulatory compliance. ING's capital position is arguably the strongest component of its investment case, ensuring dividend safety, providing a competitive advantage, and positioning the bank favorably against evolving regulatory demands. A. Common Equity Tier 1 CET1 ratio analysis. ING concluded 4Q 2024 with a fully loaded CET1 ratio of 13.6%. This robust level demonstrates significant resilience, although it decreased slightly from 14.3% in 3Q 2024. The decrease was a direct consequence of the announced shareholder distribution, which involved a 2.5 billion deduction from capital, partially offset by the inclusion of 0.6 billion from the quarterly net profit after dividend reserving. The bank's strategic target for the CET1 ratio is around 13%. The 13.6% reported ratio operates with significant headroom above the prevailing regulatory fully loaded minimum distributable amount level, which was expected to be around 11.2% in 3Q 2025. This comfortable margin is further protected by a management buffer, inclusive of Pillar 2 guidance, estimated to be around 180 basis points. This capital strength validates the bank's ability to withstand unforeseen economic stresses while continuing its core business operations and planned distributions. B. Leverage ratio and capital generation capacity. Complementing the risk-weighted capital ratios, the non-risk-weighted leverage ratio remained stable at a strong 4.7% in 4Q 2024. This metric underscores the bank's low leverage profile relative to its total exposures, meeting the stringent requirements applicable to G-SIBs globally. The bank's high profitability is the engine of its capital strength. The 13.0% ROE drives structural capital formation, yielding sustained capital generation that adds over 2 percentage points to the CET ratio annually, on average over the last 3 years. This consistent internal capital surplus is the foundational support for the high total shareholder yield. Management is actively engaged in optimizing the capital structure. The capital accretion driven by strong profitability leads to a CET ratio, 13.6%, that consistently exceeds the target, around 13%. The strategy is to deploy this excess capital efficiently, primarily through distributions, dividends, and buybacks, rather than allowing capital to become inefficiently trapped on the balance sheet. This deployment, as seen in the $2.5 billion distribution announced in 4Q24, maintains the CET ratio near the optimal target while maximizing shareholder value, confirming management's commitment to capital efficiency. C. Regulatory constraints and future capital requirements. ING is preparing for the implementation of the final Basel IV standards. The bank's long-term target CET1 ratio of approximately 12.5% is comfortably below its current reported figure, suggesting robust readiness. Management expects only a negligible impact from the implementation of Basel IV and other model updates in 1Q 2025. Regarding capital distribution, the primary regulatory constraint is that the CET ratio must remain above the MDA level after any distribution. Given the significant buffer maintained above the MDA threshold, ING possesses substantial capital freedom. Furthermore, the bank's distribution policy adheres strictly to prevailing ECB recommendations regarding shareholder payouts, ensuring distributions are exceptionally secure from a regulatory standpoint. V. Cash flow dynamics and operational capitalization. For banking institutions, the direct measurement of net cash from operations is complicated by large, volatile movements in loans, deposits, and financial assets, which dominate the operating section of the cash flow statement. Nevertheless, the underlying operating model of ING ensures stability in its core cash generation, demonstrating exceptionally low capital intensity. A. Stability of net cash from operations. The stability of the bank's underlying cash flow is inherently linked to the size and low volatility of its core deposit base, which grew strongly by 7% in 2024. Although the detailed components of operating cash flow are complex for a bank, the resulting profitability converts efficiently into available resources. For instance, in December 2023, the free cash flow per share was reported at $3.63. This high metric, relative to the bank's earnings per share, affirms its strong operational capability to convert net profit into distributable cash flow. B. Investment in technology and capital expenditures, CapEx. A salient feature of ING's financial structure, indicative of its digital operating model, is its extremely low requirement for net capital expenditure. Data from December 2023 showed net capital expenditure at a minimal €208.7 million. This figure is negligible relative to the bank's total asset size and net income. This minimal net capex profile is a direct consequence of the strategic priority placed on utilizing a scalable and modular technology foundation. The bank minimizes investment in heavy fixed capital, capex. Instead, the substantial investment required for digitalization is largely focused on software development, personnel, and cloud services, which are typically expensed as operating expenditure, OPEX. This strategic choice generates significant operational leverage, as confirmed by the bank's low capital intensity. A low capital-intensive model minimizes reinvestment risk and maximizes the proportion of the high net income available for immediate growth funding, balance sheet fortification, or, most importantly for shareholders, distribution. C. Earnings growth forecast and drivers. ING's ability to sustain and grow its earnings per share, EPS, is driven by both core operational expansion and the strategic reduction of its share count. The current market outlook reflects a mixed view, combining strong near-term estimates with conservative long-term projections. A. Historical EPS acceleration. The reported earnings per share, EPS, for 2024 stood at €2.00. This performance was augmented by the effectiveness of the bank's proactive capital management strategy. The ongoing share buyback program achieved a significant 7.4% year-over-year reduction in shares outstanding. This dual-engine strategy, high core earnings coupled with an efficient reduction in the denominator, is a primary source of EPS acceleration. B. Analyst consensus and forward guidance. Analyst consensus points to continued near-term strength, projecting a robust EPS growth rate of 10.28% for the current year, FY 2025. This optimistic short-term view is predicated on the momentum established in 2024, particularly the expansion of core lending and deposits, as well as continued fee income growth. However, the consensus forecast for the next 5 years' EPS growth is considerably more conservative, standing at 6.00%. This projection is notably lower than the peer and industry average of 12.10%. This discrepancy in growth expectations warrants deeper scrutiny. The conservative long-term forecast, 6.00%, likely rests on assumptions of a normalized lower interest rate environment, leading to compression in NII, thereby suppressing organic revenue growth. However, this view potentially overlooks key structural advantages. The bank's high 13% ROE means that even after distributing 50% of resilient net profit, the retained earnings should theoretically fund an underlying organic growth rate greater than 6.00%. Furthermore, the forecast may not fully incorporate the compounding effect of the share buyback program. If management continues to deploy excess capital via tax-efficient share count reductions, the reported EPS growth will consistently exceed the underlying operational growth rate. This mechanism creates a likelihood for positive earnings surprises relative to the conservative long-term consensus forecast of 6.00%. The lower analyst expectation thus establishes a favorable benchmark for the bank to surpass, offering potential value creation if capital management remains effective. 8. Dividend safety and shareholder return policy. ING's commitment to providing an attractive and sustainable return to shareholders is a core element of the investment thesis, securely founded on its capital strength and optimized distribution mechanism. A. Distribution policy and total yield. The bank's stated distribution policy targets a 50% payout of resilient net profit, delivered through a combination of cash dividends and share repurchases, favoring cash distributions. For the fiscal year 2024, the board has proposed a final cash dividend of €0.71 per ordinary share. Crucially, the total shareholder remuneration, encompassing both dividends and active share buybacks, yielded an attractive return of over 15% in 2024. This total yield is significantly enhanced by the dual-pronged approach to capital return. B. Dividend security and capital coverage. The safety and sustainability of these distributions are robustly secured by the bank's capital structure. The CET1 ratio of 13.6% at the end of 2024 provides a substantial capital buffer far exceeding the maximum distributable amount threshold required by regulators. The prerequisite for any distribution is that the post-distribution CET1 ratio must remain above the prevailing MDA level. Given the wide margin between ING's current capital level and the MDA, the planned distributions are exceptionally safe from a regulatory intervention perspective. Furthermore, the conservative 50% payout ratio ensures that half of resilient earnings are retained to fund growth and fortify the balance sheet, ensuring long-term dividend coverage. C. Strategic optimization of buybacks. A sophisticated element of ING's capital return strategy involves optimizing the tax efficiency of its share repurchases under Dutch law. While additional distributions in the form of a share buyback are ordinarily subject to a 17.65% withholding tax, this tax is exempted if the cash dividend paid in the calendar year exceeds a company-specific hurdle. For ING, the cash dividend payments in 2024 successfully surpassed this hurdle, which was approximately €3.1 billion. By generating sufficient cash dividends to meet this threshold, the bank ensured that the associated share buyback program benefited from tax exemption. This highly efficient capital management maximizes the effective return delivered to shareholders, particularly those subject to international tax regimes. The ability to utilize share buybacks without the punitive withholding tax structure significantly enhances the value proposition of the total distribution yield, which reinforces the sustainability and attractiveness of the total shareholder return strategy. The hurdle for 2025 is approximately €3.25 billion. I. Current valuation assessment and investment conclusion. The valuation of ING Groep N.V. must be assessed through the lens of its operational quality and capital strength, benchmarking key ratios against historical norms and peer valuations. A. Price-to-earnings (PE) analysis. The current PE ratio for ING is reported between 10.76 and 13.0x. Compared to its own historical performance, the current PE of 10.76 is slightly greater than the 10-year mean historical PE of 9.91x. This slight premium indicates that the market acknowledges the recent high level of profitability achieved in the favorable rate environment. When benchmarked against peers, the PE of 13x is slightly above the industry average of 12.4x. This small premium is justifiable given ING's superior ROE of 13% and its demonstrable capital safety profile, 13.6% CET1. B. Price-to-tangible book value assessment. ING's price-to-book value, PTB, stands at 1.34x. For a financial institution, this multiple reflects the market's perception of the quality and sustainability of the return on equity. A PTB multiple greater than 1 is validated by an ROE that consistently exceeds the bank's cost of equity. ING's achieved ROE of 13% strongly supports its current PTB multiple and suggests that the bank's assets are capable of generating value above their accounting cost. C. Intrinsic value perspective. A forward-looking intrinsic value analysis suggests that the market may be substantially undervaluing ING. Certain discounted cash flow models indicate a significant gap, estimating the stock as highly undervalued, in some cases by as much as 68.5%. This considerable disparity between the market price and intrinsic value implies that investors are heavily discounting future cash flows, likely due to an overly cautious view of future macroeconomic stability or anticipated downward pressure on net interest margins. The analyst consensus projected stock price by November 2026 is €23.54, which indicates an expected upside of over 10% from certain current market prices, suggesting that analysts foresee a material re-rating. D. Investment conclusion. ING Groep N.V. represents a high-quality, strategically focused European banking institution offering a compelling value proposition. The bank's financial profile offers an attractive combination of stability, high income generation, and capital efficiency. The safety of the investment is secured by robust regulatory capital buffers, evidenced by the 13.6 CET1 ratio, which far exceeds internal and external requirements. The income component is highly attractive, delivered through a tax-efficient and secure distribution strategy that generated a total shareholder yield exceeding 15% in 2024. However, the current valuation remains modest relative to the fundamental quality of its earnings power, 13% ROE. The key to unlocking the full intrinsic value potential lies in the bank's ability to maintain the momentum of non-interest income growth, fees surpassing €4 billion. By demonstrating that its diversified income streams can effectively offset potential compression in NII during future rate cycles, ING can alleviate market skepticism. A successful demonstration of this earnings resilience is expected to lead to a significant expansion of its PE and PTB multiples, closing the current valuation gap. The investment thesis is structurally sound, contingent on management's continued execution of the income diversification strategy within the existing disciplined capital framework.